Good evening, everyone, and welcome to our webinar tonight. I appreciate you joining us. Tonight, we're going to be going over understanding Trump accounts, a new way to build retirement wealth for your children. First, a couple of housekeeping notes before we get started. Reminder to any of our Tustin clients who might be online about our recent office move. We're literally across the street from the old offices, and hopefully you've received a postcard with that new information. Want to let everyone know that this webinar is being recorded, and the recording is available on our website and YouTube starting sometime next week. If you have any questions during the webinar, if you can enter them in the chat box, and I should have time to answer them after the presentation. My name is Rob Nathan, and I am a certified financial planner and licensed tax preparer here at Anchor Bay Capital. I'd like to take you through our agenda and learning objectives for tonight. What are they? We'll discuss exactly what a Trump account is and how it can fit into the current options for retirement savings. How do they work? We'll review their features and differences from traditional retirement accounts. The pros and cons. As with most investments, there are some great benefits, but also some rules that investors should be aware about. How to establish. We'll take a broad overview of how to open a Trump account if it seems like an appropriate investment option for you. And then other options. We'll take a look at some other retirement savings options, as well as other options available to save for your child. Before we dive into Trump accounts, I'd like to review the history of tax-advantaged accounts. Now, this timeline shows the history of tax-advantaged accounts. As you can see, the newest entrant being the Trump accounts in 2026. Traditional IRAs, or individual retirement accounts, most people are familiar with these. These offer tax-deferred savings, but are taxable on distribution. Required minimum distributions, or RMDs, are required by age 73, and that's eventually moving to age 75. Now, there are limits to contributions, $7,500 or $8,600 if you're over age 50. And there are phase outs for the deductibility of contributions based on your modified adjusted gross income. 1996 saw the advent of 529 plans, and these contributions are after tax, but growth occurs tax-free if used for qualified education expenses. Next came Roth IRAs, and these contributions are made with after-tax dollars, but growth and distributions are tax-free, and there's no RMDs. Coverdale ESAs have almost become obsolete. With the improved options and flexibility of 529s, these have limited contributions and income requirements, and quite frankly, I can't think of any clients at Anchor Bay that have one of these accounts. HSAs in 2003, this is the triple crown of tax-advantaged accounts. Tax-free contributions, growth, and distributions when used for qualified medical expenses. Next, we have ABLE accounts. These are tax-advantaged accounts for individuals with disabilities, and they operate very similar to the rules of 529s, but account holders should be aware of the $100,000 threshold that can impact the government benefits. And then finally, Trump accounts, the most recent addition and focus of our presentation today. When we talk about tax advantage accounts, what exactly does that mean? Tax advantage accounts offer savings on taxes in three main ways. A tax deduction, a deduction you take on your taxable income for that year. An IRA contribution within the required adjusted gross income would be an example of this. Tax deferral means the taxes due on the investment are deferred until a future date. 401k contributions are not taxed until the money is distributed from the account. And then tax-free growth. The growth of the investment is tax-free, as is the case with the Roth IRAs. Now, when we think about tax advantage accounts, we need to think in terms of when is Uncle Sam going to get his cut? Because we all know Uncle Sam always takes his fair share. If there is a tax deduction or tax deferral, you are simply putting off your payment of taxes. This allows a larger amount to be invested and grow, but the tax bill will be coming down the road at some point. Now, the hope here is that you will be in a lower tax bracket when the funds are accessed and your tax bill comes due. Tax-free growth occurs for money that has already been taxed before the investment, as is the case with Roth IRAs. Now, since taxes have already been paid on the initial investment, the distributions are tax-free. With uncertainty about your future income or tax rates, this can be a powerful investment option. Again, the only current way to beat the tax man is the use of HSA health accounts, tax-free contributions, growth, and distributions when used for qualified medical expenses. This raises the point that all tax-advantaged accounts are not created equal. In many instances, the use of the funds must be for the intended purpose to receive the tax break. So, what exactly is a Trump account? It's a tax-advantaged retirement account designed for minors with no earned income that must be opened by a qualified person. And we'll get into that more later. The tax advantage portion is deferral of taxes owed on the growth portion of the contributions. Since the contributions are generally taxed, those are distributed tax-free. It was created by the One Big Beautiful Bill Act in July of 2025. However, accounts could not be opened until July 4th of this year. Trump accounts, as they are most commonly referred to, are also known as 530A accounts, which is the IRS revenue code that governs these accounts. Trump accounts are brand new, and this means that you can expect changes to some of the rules surrounding them in the future. So it's important to stay informed about any updates to the terms of the account. This is the case with 529 education plans, which have seen many updates and changes to the plan in recent years. So let's take a high-level view of Trump accounts before we dive further into the mechanics of the growth period and beyond. Think of Trump accounts as a starter IRA for minors, but unlike IRAs, they do not require earned income. Beneficiaries must be U.S. citizens with a valid Social Security number and be opened any time before the year they turn age 18. There is a hierarchy of people who can open Trump accounts, but in most situations, it's going to be the legal guardian or the parent of the child. Trump accounts can only be opened and contributed to up to the year the child turns 18. So for example, if your child turns 18 in June of 2044, you have until December 31st of 2043 to open and contribute to the account. On January 1st of the year that your child turns 18, the control of the Trump account will pass to the beneficiary, where it would be converted to either an IRA or Roth IRA, and more on that option later. We will first look at what is known as the growth period of the Trump accounts. This period is defined from the day the account is opened until the year the child turns 18. One of the biggest restrictions, but it could also be viewed as a potential benefit, is there are no distributions allowed from the account during this time. The only exception to this would be the death of the child, and funds would be distributed according to the designated beneficiary and taxable to the inheritor, or the estate if there was no beneficiary named. There are a limited selection of investments available for Trump accounts. The investments must be in index funds that invest in US companies only. Now, an example of this would be the S&P 500 index fund. While this presents some limitation on investment options, the S&P index is considered a very solid and reliable investment, a core foundation for any beginning investor's portfolio. There is also no use of leverage in these accounts, which would include things like margin accounts or options. There is a $5,000 annual contribution limit. Contributions are non-deductible and made with after-tax dollars. There is also no AGI limitations on making contributions, since the contributions are after tax, and anyone can make contributions to the account, such as grandparents or other family members. However, all contributions aggregate to that $5,000 annual limit. Contributions are considered gifts and therefore subject to the annual $19,000 per person per beneficiary gift tax rules. Now, this is an important recent change, as under the initial setup, this was not the case. To qualify for the gift tax exclusion rule, it must meet the present interest standard, meaning the gift is immediately available to the beneficiary. In the case of Trump accounts, since distributions are not allowed during the growth period, they do not meet the standard. However, an exception to this rule has been made, allowing Trump account contributions to qualify for the annual $19,000 exclusion. Employers can contribute up to $2,500 annually, and that will be indexed for inflation. These contributions are deductible for the employer and excluded from the beneficiary's income. As these accounts are brand new, the list of these companies is somewhat limited. There's about 50 or so right now, but I expect it will grow over time and become a more common benefit offered to employees. I have a client who works for Chipotle that is eligible to receive a $1,000 contribution to these accounts. But again, it's an important factor to remember here. Those employer contributions do count towards that $5,000 limit. One final note is that contributions to a Trump account do not count towards IRA or Roth IRA contributions. So therefore, an eligible minor who has earned income could potentially contribute up to $7,500 to an IRA or Roth IRA and have an additional contribution of $5,000 made to their Trump account, resulting in a total of $12,500. We'll dive more into compounding returns later, but that could be an amazing start to a very successful retirement. Charitable and government contributions can be added with no limit or impact on the maximum limits. For eligible U.S. citizens born between 2025 to 2028, the U.S. government is contributing $1,000 to that child's Trump account. In addition, the Dell Foundation is offering a $250 contribution for children under the age of 10 who are born before January 2025 and aren't eligible for that $1,000 federal contribution. The families must also live in a zip code with a median annual income under $150,000. But these are just two examples of some of the free money available for these accounts. As with employer contributions, I expect the number of these opportunities to continue to grow in the future. So what happens after the growth period? Well, on January 1st of the year the child turns 18, the Trump account automatically converts to a traditional IRA and is now under the beneficiary's control. This happens on January 1st, even if the beneficiary doesn't turn 18 until that December. From there, the normal IRA rules apply. That means distributions before age 59 and a half are subject to a 10% penalty and income taxes. There will be required minimum distributions, which under the current schedule would be age 75 for anyone who's eligible to open a Trump account. However, this could change in the future as well. Now, one possible strategy at this point would be to convert the funds into a Roth IRA. Now, most likely, the beneficiary will be in a 0% or very low tax bracket at this point, making it an optimal time for these conversions. The Roth IRA converted money would then grow tax-free for multiple decades and allow for tax-free distributions of the money. And there are no required minimum distributions on Roth IRAs. Keep in mind, since contributions to Trump accounts are made with after-tax dollars, taxes would only be owed on the growth of those contributions on the conversion. If the account remains in an IRA, the basis would need to be tracked. The basis, or the contributions, would come out tax-free and earnings distributed as ordinary income at the owner's tax rate at that time. This is done on a prorated basis, which I'll detail shortly. Now, once the account has been converted to an IRA or Roth IRA, only contributions on earned income would be allowed based on the limits at that time. One of the greatest potential benefits of opening a Trump account is the power of compounding returns. Compounding returns simply means generating earnings from both your original money and the prior profits that you reinvest. Compounding returns can be a tremendous creator of wealth, and having 5 or 6 decades of compounding growth could be extremely impactful. In my scenario here, if you invested just $50 per month in a Trump account from a child's birth up to the year they turn 18, and we're assuming an 8% return, which would be considered historically true for the S&P 500, the account would be valued at about $21,500. Once rolled into an IRA and adding no additional funds, just allowing it to compound for another 47 years, again, assuming that 8% return until the owner turns age 65, that initial investment of just $10,200 would turn into over $800,000. Now, that's a return of over 7,800%. That's pretty amazing. Now, this assumes no other contributions to the retirement savings are made. In the second scenario, even if nothing is added to the Trump account except the federal government's $1,000 and, say, a charitable contribution of $250, assuming that 8% return throughout the entire investment period, you could expect to have $170,000 in the account by the time the owner turns 65. Now, we're going to take this one step further, and if at age 65, the money is invested with a reasonable rate of return of 4%, the owner could receive $32,000 per year of income with no loss of capital. I make this point because, as we all know, Social Security is facing issues of solvency. While the impacts will most likely be none or minimal to current or near-term recipients, there is no doubt Social Security will look much different for this new generation. In addition, pensions are also becoming much rarer. So the new generation will be even more reliant on personal savings to fund their retirement. So let's recap some of the major benefits of the Trump accounts. First, it allows children with no earned income to begin a retirement account as early as the year they are born. This gives a possible 16-year or so head start for an owner who might not have earned income with their first job and be eligible to contribute to an IRA. And as I think was powerfully demonstrated in that last slide, this adds years of compounding growth. There is no more powerful amplifier to increasing your wealth than time. Also, with the addition of an IRA or Roth IRA, once the child has earned income, there is the possibility of saving up to $12,500 per year for retirement at an extremely young age. I think it also gets children thinking about retirement at an early age and teaches them about the power of compounding growth. I think sharing the information about the account with the child as they get older would get them excited and encouraged to save and invest even a small amount for their retirement. I've had many clients who have neglected retirement savings until later in their lives. And unfortunately, I can tell you the amount of monthly savings required for an adequate retirement will increase exponentially the later in life you start. If for no other reason, invest in a Trump account for the free money. With the current government contribution, charitable organization, and employer contributions, just adding this amount to the account could have an impactful effect on their retirement. Also, I strongly suspect the list of opportunities for these contributions will continue to grow. And finally, Trump accounts do now qualify for the $19,000 gift exclusion. And this eliminates the need of additional time and cost in filing a gift tax return. Well, we know it can't all be a bed of roses. So now let's turn to some of the negatives associated with Trump accounts. There are no distributions from the account during the growth period. The only exception to this rule are death or a complete rollover of funds to another Trump account. As all Trump accounts eventually become IRAs, the same rules will hold. This includes a 10% penalty before age 59 and a half and RMDs. And there's also some additional record keeping requirements. Since contributions are after tax, they contribute to basis, which means they are not taxed when distributed. Only the growth portion will be taxed at the owner's tax rate at the time of the distribution. Currently, the agent of the accounts are required to supply the cost basis annually. However, this may fall on the owner once the account is converted to an IRA. One possible strategy would be to maintain a separate IRA account once the Trump account is converted, allowing for easier tracking process. Record keeping could get more complicated if tax-deductible IRA contributions are added in the future. The investments are limited. Bonds, individual stocks, mutual funds, and most ETFs, commodities, as well as international investments are not allowed. That's at least for the growth period. There's limited flexibility. With the funds essentially tied up for almost 18 years, there's no option to use for any other purposes. However, this does create a forced retirement savings strategy, at least for this time period. And accounts can only be opened by specific people. The current hierarchy is legal guardian, parent, adult sibling, then grandparent. In each case, the previous person must not be available to open the account for it to fall to the next qualified person. Therefore, grandma and grandpa could not open the account should any of these other people be available. However, this does not preclude gifts from being made from other parties. So, how do you open one of these Trump accounts, you ask? Well, I'll tell you. The first step in opening a Trump account is to file Form IRS 4547. This could have been done on your 2025 tax return or on future tax return forms. Or it can be filed at trumpaccounts.gov, which is the official website for Trump accounts. Or you can do it through the IRS website. Once the form is filled, you will receive an email directing you to trumpaccount.com. Now notice this is a .com address in singular, trumpaccount.com. This email will usually arrive in about 3 days. The only current financial agent for Trump accounts is Robinhood, who will be the party sending this email. However, there may be no obvious Robinhood branding that appears. Just be aware of that change in the domain name in looking for the confirmation of the setup of the account. And there are no fees to open a Trump account. There's only one Trump account allowed per beneficiary. Once this account is established, no other party can open a Trump account for that individual. Now, the final step is to fund the account. You can contribute with a debit card or link a checking or savings account. And although Robinhood is the initial financial agent for all accounts, it's very likely that other brokerages, such as Vanguard, Fidelity, Charles Schwab, will offer a transfer option for your Trump account. Should you have a preferred brokerage you work with, you will most likely have this option in the future. However, the account will need to be transferred over in full, as there is only one account allowed per individual. There's also a Trump app that can be downloaded to your phone to manage the account. I download it for purposes of this presentation, but since I don't have any children with Trump accounts, they're too old. I know I don't look it, so I couldn't log in. However, I expect there to be some nice graphics and information provided on the growth of these accounts. Sharing this app with your child when they are old enough, we all know kids love a good app, could really get them excited to save for their retirement and reinforce that concept of compounding returns. Other questions about opening accounts can be answered at trumpaccounts.gov, where they also provide a phone number to call for more information. Currently, the default investment for all Trump accounts is the State and Street SPDR S&P 500 fund. This fund is known as an index fund and tracks the S&P 500, which contains the 500 biggest companies in the US. It has an extremely low expense ratio of 0.02% or 2 basis points. Other funds that are available include the Vanguard Total Stock Market, the SPDR S&P 1500 Composite Stock Market, and the iShares Total US Stock Market. While these funds are similar in nature, there's most likely not a need to spread your investment across these accounts. It essentially comes down to if you want a pure S&P index fund, which tracks large cap companies, or one that follows the total US market, which would include the addition of mid and small cap companies to provide more diversity. Either way, all of the companies with the ETFs are US companies. It's likely in the future more investments are added either by Robinhood or other financial agents. And again, while these investments are limited, any of these funds could be considered a solid core foundation for any beginning investor. The contributions, as we discussed, can be made with debit cards or linked bank accounts or from third-party gifts from the government, charities, or employers. Through the Trump account, you can generate a QR code to send to family members who may want to contribute to the account as well. Tracking cost basis can be an intimidating phrase or concept. The financial agent will provide this tracking on an annual basis with Form 5498-TA. Once the Trump account is converted to an IRA, it may fall upon the account owner to track the basis, so record keeping is extremely important for these accounts. It's one reason it may make sense to keep these funds in a separate IRA. However, if the funds are converted to a Roth IRA, which may be an excellent strategy based on the owner's income at the time, there would be no further record keeping required. The after-tax contributions to the Trump account would roll over tax-free, and the growth of the account at that time would be taxed at the individual's current tax rate. Again, for most 18-year-olds, this could be 0% or certainly a very low rate. Depending on the rollover amount, which does add income, this could be done over several years during a time of lower earnings for the owner. To calculate your taxable amount, let's review this example. Let's say $100 of after-tax contributions were made. If the account value is $400 at the time of the distribution, there has been $300 of growth. Dividing the total distribution by the amount of the contribution, 100 by 400, we get 25%. This means 25% of the distribution is tax-free. since taxes were already paid on this amount, and the balance of $300 would be taxed at the individual's tax rate at that time. Now let's review some of the other investment options that are available and compare them to Trump accounts. The most obvious comparison would be to individual retirement accounts, or IRAs. As we've learned now, all Trump accounts eventually become IRAs, so the rules for these accounts will basically be identical. The main difference will be Trump accounts that become IRAs will contain some amount of basis, the after-tax contributions that will come out tax-free. In the case of traditional IRAs, if the owner's income is under certain thresholds, the contributions are tax deductible at the time of contribution. This means that since a tax break has already been given, all distributions, the contributions, and growth are taxed at the owner's tax rate at that time. One other note regarding the rules surrounding IRAs. As Trump accounts eventually become IRAs, they are subject to the same rules. So up to $10,000 can be used for first-time home buyers and also qualified education expenses without being subject to that 10% penalty. However, the growth portion of the distributions will be taxed, not making them the most efficient way to save for education expenses. The big advantage here on Trump accounts is the early start. With no earned income requirements, contributions can literally start once the child has a valid Social Security number. This can add 16 years or more of extra compounding growth. When we compare Trump accounts to Roth accounts, the differences are very similar. Generally, for almost all young investors with earned income, a Roth account makes more sense than a traditional IRA due to their low income tax rates. Converting the Trump account that becomes an IRA and rolling over to an existing Roth IRA will probably make a ton of sense for most owners. The taxes owed will be very little, and it will allow for decades of tax-free growth, followed by tax-free distributions. As we discussed earlier, 529 plans are for education. So why compare a Trump retirement account? Although this is not an apples to apples comparison, I think the comparison is warranted since most families have limited dollars for investments. From one perspective, you must consider most children will have limited resources and only 18 years or so to save for their college education. They have their entire working career to save for retirement through IRAs, Roth IRAs, employer retirement plans, often with a company match, and the increasing rare pension. We all know that education costs have skyrocketed, and with recent changes, the amount of public loans available is being limited. It's currently $57,500 for undergraduates. So this could create a shortage of funds for education that would need to be filled by part-time work from the student or adding additional private loans. And these generally don't have as favorable terms as the public ones. The uses for 529s have also expanded tremendously over the past few years. In addition to traditional four-year colleges, they now include K through 12 expenses, trade schools, and certificate programs. In addition, with certain requirements being met, up to $35,000 of 529 money can be converted to a Roth IRA. 529s also offer more flexibility in distributions and transferring of funds to other beneficiaries. An individual can have multiple 529 accounts and opened by almost anyone. In fact, there are benefits for grandma and grandpa to open these accounts, as they won't count as assets during the FAFSA process. Most 529 plans also offer a wide array of investment options. The most common being similar to a target date fund, which invests more heavily in stocks in the early years and then slowly transfers to more conservative investments such as bond as the child nears age 18. At Anchor Bay, we are strong proponents of 529 plans and would most likely recommend the bulk of savings go towards a 529 plan. As both investments qualify for the gift tax exclusion, you would need to be sure not to exceed the total $19,000 per beneficiary per person limit. So, in other words, if you contribute $18,000 to the 529 account, you could only contribute $1,000 to their Trump accounts. Since the amount is per person, both mom and dad are eligible to make this contribution, so the total could be doubled. Uniform Transfer to Minor Act, or Uniform Gift to Minor Act. It's a real mouthful to say, so I'm just going to call them UTMA and UGMA accounts. Well, UTMA and UGMA accounts offer the most flexibility. However, these are not tax advantage accounts, so contributions are after tax. Income, such as dividends, interest, and capital gains, are subject to the kiddie tax. This means the first $1,350 of investment income is tax-free. The second $1,350 is taxed at the child's tax rate, and any investment income over $2,700 is taxed at the parent's rate. Trump accounts are not subject to the kiddie tax. Funds from the UTMA and UGMA accounts can be used for any purpose. They remain under the control of the custodian until the child reaches the age of majority in that state. While Trump accounts also fall to the control of the beneficiary when they become IRAs, there's at least that small deterrent of the 10% penalty for them to withdraw and use the funds for purposes other than retirement savings. There's no such safeguard on an UTMA or UGMA account. However, this also provides the beneficiary the option to use funds for needed expenses without any penalty. UTMA and UGMA accounts can also be established once the child has a valid Social Security number. So early investments can be made. There are no limitations on investment options. Opening a UTMA or UGMA brokerage account gives you access to a multitude of investments. One possible strategy here: establish an UTMA or UGMA account for your child and make small, regular contributions. Once the child has earned income through that summer job, contribute the amount of earnings up to the limit from the UTMA or UGMA account to the Roth IRA. As most young earners are spending most of what they make, this allows for contributions to be made to a Roth IRA, and this could be an optimal strategy for them. At Anchor Bay, when we talk about investment accounts for our clients, we often refer to filling the three buckets. These are tax-deferred accounts, IRAs and 401ks, after-tax retirement savings, such as Roth or 401k Roth, and taxable accounts, brokerage and savings accounts, which are subject to taxes on investment income, such as dividends, interest, and capital gains. The reason is they all offer different benefits, but having a combination of all three provides maximum flexibility in retirement. The same strategy could be thought of for saving for your children. Perhaps the largest portion to that 529 plan bucket with its many benefits, but when possible, smaller contributions to a Trump account and the UTMA or UGMA account. As we discussed, all three of these accounts have their unique benefits, so this could create a strong financial foundation for them. So, how do you decide what investment account is best for you and your child? As we have reviewed, all three accounts have their unique advantages. With limited time and the child's limited resources to save, the 529 plan does seem to stand out as the top priority. Additional resources directed to the other accounts provides flexibility and the possibility of long-term compounded returns. Utilizing that three-bucket approach could set your child up for a very successful future. Now, to me, one of the huge benefits of establishing the Trump account is to instill in your child at a very young age the value of saving and investing, and the huge benefits of time in compounding returns. When they are old enough to start by having a discussion about the importance of saving for the long term, having a real life example in their Trump account and showing them that growth in the Trump app could have a big impact on them. The lesson to be learned is that saving even a small amount now can turn into a large amount given enough time. Now, it's very possible that they empty their Trump account, turn to IRA when they can, pay the 10% penalty, and go off and buy that car. But the hope is that they can see firsthand the power of long term investing and develop a lifelong habit of saving for retirement. So, to review, Trump accounts are for US citizens with valid Social Security numbers and can be opened before the year they turn age 18. Trump accounts are retirement accounts and they are essentially equivalent to IRAs, however, with limited investments but no required earned income. There are no distributions allowed from Trump accounts during the growth period, creating an opportunity for forced savings. Trump accounts are brand new, so expect changes and revisions to the current rules, including investment options, contribution limits, and the list of government, charitable, and employer opportunities. As a matter of fact, just before starting this presentation, I was reading about the possibility of parents being able to make pre-tax contribution to a child's Trump account directly from their paycheck. Now, this would add some extra record keeping since this would be pre-tax money and therefore taxable along with the growth upon distribution. The article also mentioned more companies committing to matching contributions for their employees, which speaks to my point about the list of these opportunities only continuing to grow. Trump accounts should be viewed as an excellent way to start early on your child's retirement. With certain changes coming to Social Security, this new generation will likely be much more reliant on personal savings to fund their retirement. And there is no denying the power of time on compounding returns. Even a small amount invested at a young age could grow to a sizable amount for the owner. Finally, consider the bucket approach in saving for your child. As resources allow, contribute to the 529, Trump accounts, and UTMA and UGMA accounts. All can provide great benefits and a solid foundation for your child. So, is it worth opening a Trump account? Well, my answer here is a resounding yes. For parents with children born between 2025 and 2028, do it for nothing other than the $1,000. For others, it's worth doing for other government, charitable, or employer contributions. Perhaps grandma or grandpa throw in a few bucks here or there too, and before you know it, your child has the foundation for a successful retirement. I'd like to thank you all for your time today. Hopefully you have a little better understanding of Trump accounts and the information you need to decide if they are right for your family.